and welcome to the Financial Planning Association's annual conference. I'm here with Amy Hubble, and we are answering some questions that Investopedia has been getting from our readers. So, Amy, welcome. Thanks for joining us.
Thank you.
Let's start with one of the first questions. So, a reader has asked, for a new college graduate with a good paying first job, do you recommend a Roth IRA or a traditional IRA? What would you suggest?
Yeah, there'd be very few kind of situations where you wouldn't want to usually go for a Roth versus a traditional IRA or 401k. If they're working for a new job, they may have an opportunity where they can get a match at their new employer, and you would definitely want to take advantage of that first. But there may be some situations where you'd want to put some in a traditional or some in a Roth. But in general, all else equal, a Roth is probably going to be your best bet.
Let's take another question looking more at specific types of investments. What would you explain the difference between exchange-traded funds and mutual funds as for a reader?
Yeah, exchange-traded funds are usually called ETFs, and mutual funds are really the same thing. They're a bundle of securities that trade, and you can purchase a bundle of those securities together that someone else is managing for you, and you get diversification issues with that. So a lot of people think that they are exactly the same thing, but they trade a little bit differently. ETFs trade throughout the day on the market, versus mutual funds you can only trade one time, and you can only trade with actually the mutual fund company. Okay. So that's makes it a little bit more tax efficient to be ETF trades, because you and I can trade directly, versus if you're trading a mutual fund, I have to go to the mutual fund company and then they have to send it back. Okay. But in general, they both offer a lot of really good diversification benefits, and you want to just see kind of which one is cheaper for you to trade is probably your biggest decision, all else equal.
So this reader asks, how cautious should I be going into retirement if I'm still carrying substantial debt? And for example, this reader is talking about a mortgage, auto loans, and even some credit card balances.
Yeah, it kind of depends. If you have a credit card balance, that's really something you need to take care of whether or not you're retired or not, because you're really not going to ever be able to beat a credit card balance interest rate with any kind of investments. You want to, stop the presses, stop whatever you're doing, and get to work on paying that credit card off. However, right now, with interest rates where they are, you can get a mortgage with very good credit, sometimes at 3%. So if you can hold a mortgage debt for 3%, the investments in your retirement account are really going to be able to beat that. But a lot of people just have kind of a mental block about not wanting to be in debt in retirement, and right. You can certainly understand that.
Yeah.
But otherwise, you really want to base that of, can I beat this with my investments if I have a very low paying debt?
So let's look at one more question. A reader is asking, can I roll over funds from a 401k to a 529 plan?
Yeah, you really can't directly, but even if you could, you wouldn't want to, and I'll tell you why. It's when you file a FAFSA for a student, which is basically says what the expected family contribution is going to be for your family to be able to provide, which is what is going to qualify you for scholarships, is going to qualify you for subsidized versus unsubsidized loans. If you can actually keep that money in a retirement account, that's the assets of the parents. That's not going to be something that's going to count against a student. And secondly, you really don't want to sacrifice your own retirement account for that purpose. And while there are some tax advantages of 529 plans, a 401k plan, you've already kind of received that tax benefit going in, and if you were to take it out and put it towards a 529 plan, you might get a state tax deduction, but you would be taxed bringing money out of a 401k as well as a withdrawal penalty. Okay. So really not a great strategy.